All right, I came across this article on 10 best dividend growth stocks to buy now, and I've been meaning to make a video on this topic for a while, and coming across this article sparked the interest for me to finally make this video. Although it's not because I agree with these picks, in fact, it's the exact opposite. I think this list, especially the top 5, are the personification of why people do not like dividend investing. I mean, the main complaints you always hear about dividend investing is that these companies are past their prime, they don't have any growth left in them, and the top 5 companies that this article picked are exactly those kinds of companies. So the plan here is to show you guys the top 5 picks of this article, and I'm going to briefly explain why I disagree. Now, it doesn't mean these aren't good investments in the short term if you want to trade them. Lots of the picks are trading at a pretty fair valuation, but there's a reason for that. But let's just get into it and you guys will see what I mean. So their 5th best dividend growth stock on the market is Chevron. Chevron does have a pretty high and respectable 5.5% dividend yield, and they've been consistently increasing that dividend for 34 years. So they do have a good history. The only thing is, as investors, we have to look into the future. It doesn't matter what they did in the past 34 years if in the next 5 years they're going to be irrelevant. I'm not saying that's the case with Chevron, it's just something to note. So Chevron works to explore, develop, and produce crude oil and natural gas, process, liquefy, and transport liquefied natural gas, and offer a range of other services within the energy sector. Now, I like energy as much as the next person, but one of the main things I look for as an investor is long-term trends. It's known as a headwind or a tailwind in the market, because a company could be very well managed and a market leader, but if that market is shrinking or becoming irrelevant, that's a bad position for the company to be in, and the worst part is there's not much that they can do to change that. So here's some data. This is energy consumption worldwide from 2000 to 2018 with forecast until 2050. And the first thing to note is that both natural gas and oil, what Chevron does, will be prevalent into the future, 2050. And as we project more and more into the future, we can see what the major growth field is, and it's not oil and natural gas. It's this gray color, and this is renewable energy. So this gray color is where the growth and opportunity is for new companies to come in, take up market share, and rapidly expand with a strong tailwind. And in contrast to that, oil and natural gas will be stagnant, if not shrinking, in terms of market share, meaning that companies, in order to grow in that sector, really need to consolidate, have mergers and acquisitions, but ultimately there's just going to be less growth potential. So it might be true that in the short term, Chevron does have an attractive valuation with a PE ratio of only 14.5. But as I alluded to in the beginning, there's a reason for that, and that reason is the overarching trends we just looked at. And in fact, their total revenue have been pretty unimpressive as of lately. And when you combine that with their dividend payout ratio of over 80%, to me that's a huge red flag. And the growth in the dividend, it's very slow. It's just over inflation. So with all those factors combined, Chevron is definitely not one of my top choices. In fact, I think companies like Chevron give dividend investing a bad name. But let's move on. So number 4 on this list is Universal Corporation. They have a juicy 6.3% dividend yield and a long history of paying out dividends, although this is a tobacco company. And because of that and the market dynamics, they have many of the same shortcomings as an oil company does right now. So it says Universal is among the global leaders in the tobacco industry and is based in Virginia. The company procures, finances, processes, packs, stores, and ships leaf tobacco for sale to manufacturers of consumer tobacco products. And it doesn't take much research at all to find data like this. So this is the trends in cigarette smoking rates. Cigarette smoking rates have fallen significantly for both youth and adults, and I think we can all agree this is a great thing. We all know the dangers that come along with smoking, and many of us just on a moral level don't like to invest in companies like oil and tobacco because they harm both people and the planet. In fact, there's a term for this, and it's ESG. A lot of times when you look into investments, they have an ESG score, and this stands for environmental, social, and governance. And you can see some of the major points here that people look at. And this matters because lots of institutionals and individuals really put a lot of weight on this rating. And it's just another headwind for the company to fight against. But coming back to the data, we can see here that the adult smoking rate back in the 1960s was very high at 42%, and nowadays it's down in the teens, around 13.7%, dating back to 2018. And in terms of percentage, that's a 68% decline over that time period. Less people smoking is definitely a positive, but for this company, it is a very concerning figure. And again, if we look at the revenue of this company, it has been very stagnant over the past couple of years. And when we look at the dividend data, it's also very concerning. We see that very high payout ratio. This is not healthy at all. I like to see payout ratios below 50%, but this is touching 80% with stagnant revenue. So that is a ticking time bomb. Okay, moving on. Number 3 on this list of the best dividend growth stocks to own is ExxonMobil, another oil company. And I think at this point you can see why I was so agitated by this list of quote unquote the best dividend growth stocks. It's not even the best dividend stocks. They label this the best dividend growth stocks. These companies have an 80 to 90% payout ratio. That is not good for dividend growth qualities. I'm not going to take a deep dive into this one because it's very similar to Chevron. Of course, the quality of the company, the management might be different. I'm not saying there's not a short-term trading opportunity with any of these companies. As an investor, my style is to look at long-term trends. I feel like that's the only way to really be a stock picker. If you ignore long-term trends and you solely invest and trade based off of PE ratios and other subtle metrics, that makes you a trader in my view, and that's just not what I'm about. Number 2 on this list is Altria Group. They have a high 7.1% dividend yield and 51 years of consecutive dividend increases. Now, Altria Group is amongst the largest global producers and marketers of tobacco, cigarettes, and related products. I feel like the only thing they're taking into consideration is one, a low PE ratio, and the years of consecutive dividend payments, which I have to admit they are very respectable, but again, I'm a long-term investor. I look at the overarching market trends, and I look for growth and opportunity in the company's future, not just mergers and acquisitions in a shrinking market. So with this company, they have very stagnant revenues, and if we take a look at their payout ratio, it's high. It's close to 80%. I have to say the dividend yield is very attractive. I can see why the stock is appealing for some people, but the growth rate in the dividend, it's good, it's around 80%, but all that's doing is putting upward pressure on this payout ratio, while if we come back to this data, the market for their product is shrinking and less people are buying tobacco products. So long term, I think it's just a losing bet of a company. And that leads us to number 1, which is AT&T, ticker T. Now finally, this is not an oil or tobacco company, it's a telecom company. So AT&T offers a range of communications and telecom services, such as wireless voice and data communication services, video, and targeted advertising services. Now AT&T is a very unique situation. As of recently, in an attempt to lower their debt, which is a good thing, they went ahead and sold some of their assets, including Warner Media. But the thing is, this is where all the growth and the excitement for their stock was. HBO Max was one of the main players competing with Disney Plus, Netflix, and had real opportunity to grab market share in a growing market. But the company sold it off and they cut their dividend in half, which generally speaking is good for the financials of the company, but for the investor, I do not see AT&T as being the best dividend growth company by any means. Now, the companies that I think are some of the best dividend growth companies on the market are names like Microsoft. This is one of the largest and most successful companies in the world. Their revenue is growing by 21% year over year. Their revenue segments include productivity and business processes, intelligent cloud, and more personal computing. And if we look at these one at a time, each one of these segments is growing. Yes, their dividend is only 0.8%, but their payout ratio is extremely healthy. The company is making more revenue every single year, and they're growing the dividend at a 10% rate per year. So I view this company as being very dominant in a growing market segment with strong financials. Another company I think is amazing for dividend growth is American Tower Corporation. And what this company does is they rent out infrastructure and real estate to companies like AT&T and Verizon, plus many others around the world. They're not just limited to the US. And I view this position as being the landlord of Verizon and AT&T as being a much more insulated and stronger business model. So essentially, as the demand for wireless communication increases, the demand for the product that this business has is only going to increase. This is some data on active internet users in billions, and currently the global population is getting close to 8 billion, so only about half of the population currently has access to the internet. That's why this segment has immense growth ahead of it, plus things like 5G. I see consistent and steady demand for this company's product. Another great dividend growth name is Home Depot. Here's an article labeled 33 Surprising Home Improvement Trends and Statistics in 2021. The first one is home remodeling searches have more than doubled from 2020 to 2021. Here's some data on that. Home appliances searches have increased by 26%. There has been an 8.5 increase in revenue from home improvement companies like Home Depot. 22% of homeowners will spend between 5 and 15,000 bucks on projects, and the data just goes on, showing the strength and momentum in the home improvement sector, which a company like Home Depot operates within. And yes, I realize Home Depot right now has a higher PE ratio than most of the other companies originally mentioned on the list, but again, I look long term, not just short term trading, and look at the revenue growth of this company. They have a payout ratio that's very healthy, only 45%, and they're growing their dividend about 20% per year. Moving on, another great dividend growth name is BlackRock. And BlackRock is a company that produces lots of the financial assets that you might be investing in right now. IGV is just one of many of their products because iShares is the brand that BlackRock owns. So they put these awesome investment vehicles together. I'm a huge fan of a lot of their funds. I think they make some of the best ETFs on the market. We can see here this one has 5.4 billion in assets under management, and BlackRock collects a 0.43% expense ratio on that. So that's a great source of revenue. And the personal finance sector of the economy is only growing as of recently. I mean, you're watching a video on YouTube right now about this very topic. It's becoming trendy, people are getting into it, and I think that's a great thing, and BlackRock is going to be a beneficiary of that whole trend. And the last company that I think is a great dividend growth option is United Health Group. They are the largest healthcare provider in the US. And when it comes to healthcare, the biggest threat is just government intervention. But the general field of people needing healthcare coverage isn't going away anytime soon. And in fact, with population growth, they're only going to have more and more revenue. Here's a little breakdown of how they collect their revenue by year. They have three main categories: services, products, and premiums collected. And we can see the immense growth of each one of these segments over the past couple of years. Their payout ratio is extremely healthy at only 30%, and that extreme revenue growth we just looked at, along with all this headroom, is what allows United Health Group to have a sustainable 20% growth rate in their dividend every single year, and that is powerful. So basically, I just got triggered by that article that showed old, dying dividend companies, and I think it gives dividend investing a bad name. So I gave 5 companies I think are much better dividend growth alternatives, and they're actually in growing segments with strong revenue growth and very bright futures. But that's the end of the video. If you're still watching and enjoyed, give the video a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.